pick up important topical issues, which this month we will spend on the issue of productivity growth. How much productivity growth do we need and how much are we having right now? This is a good time to talk about this topic. We have had quite a few years, as many of you know, otherwise you wouldn't have tuned into this webcast, of weak productivity growth, but some of the recent measures are showing us that there's actually something of a modest recovery going on. And this is important because productivity is, as we all know, a very critical driver of value performance for businesses. And even though businesses don't measure productivity on a day-to-day basis, every business leader knows that efficiency gains, that growing market volume, that especially technology innovation, those are the ones that make it possible to get more out of your business than what you're actually putting in. And that is essentially what productivity is about. At the macroeconomic level, productivity is in fact the only sustainable source of medium-term growth. So some of our questions are around why is it that productivity then has been growing so slow for a very long time? What is driving some of that recovery? And should we have to take that recovery really serious, or is that just a temporary phenomenon? So what should we watch at? So today we have a very important series of topics to talk about, and we have an excellent panel from around the world, the US and Europe, to talk about this topic. Our first topic is really at the economy-wide level. Is the recent productivity recovery that I just mentioned, is it real, or are we still in the middle of some sort of long-term slowdown that is ongoing now for more than a decade? What are the true drivers of productivity growth? Our second topic is that what is going on with this digital economy that everybody's talking about and that we have spent some of our window on programs on also? If we have all the digitization in the economy, why don't we see the productivity growth coming forward much more quickly than we would have hoped for? Or is it perhaps still coming and we just have to wait a little longer? Thirdly, maybe productivity is good for the economy, but what does it actually mean for jobs? What does it mean for the labor market? What are the threats to the labor market from the digitization that I was just mentioning? Should companies worry about this one way or another in terms of access to talent? And finally, if productivity matters so much, what are we doing about it to make it better? What policy measures are being taken, but also what is it that corporates and that individuals can do in this light? And indeed, we have an excellent panel with us today that's going to talk about these issues. First of all, we'll have Jana Remas, who's a partner at the McKinsey Global Institute and one of the key authors on the latest productivity study that the McKinsey Global Institute has published. Jana, welcome to this show.
Thank you. A real pleasure to be talking about one of my favorite topics.
Absolutely, and I know it's going to be fun with you, as always. And then Dirk Pilatz, a good friend of ours and also a good friend of the Conference Board, Deputy Director of the Science and Technology and Innovation Department at the OECD, and so a big player in the productivity scene. Dirk, welcome.
Thank you, Bart, and pleasure to be here.
Then we have from the UK, Steen Westlake. Steen is a Senior Fellow at Nesta, the Innovation Network in the United Kingdom. He's the co-author, together with Jonathan Haskell, of a leading book on intangible capital, what is the things that we're not seeing behind the investment that firms are doing, and what does that mean for productivity growth. Steen, it's great to have you on.
Thanks, Bob. I'm looking forward to a productive conversation about productivity today.
Great. And then finally, last but not least, Michael Hüter, Director of the German Economic Institute in Cologne, also somebody we've worked with for a very long time on issues of productivity. And Michael, it's great to have you as part of this conversation.
Yeah, many thanks for inviting me, and greetings from Berlin. It's a sunny day, and I'm hopeful for our productivity discussion today and what we will see in productivity.
And then I said last but not least, but I should be forgetting about somebody very important who's with me in the studio, and that's my colleague, Klaas de Vries. And Klaas is actually leading a lot of our productivity work here at the Conference Board. And Klaas, we couldn't run this show without you. Welcome.
Thanks, Bart. I'm glad to be here and to be also talking a little bit about the numbers, and it's just be behind the scenes and constructing the data.
Looking forward to the conversation. All right, few quick things for you to get most out of this webcast. First of all, it's an interactive webcast, so you can ask as an audience questions, and please do that by typing out those questions in the chat box at the bottom left of your screen. You can download the presentation. There's not much of a presentation today, but there are a few slides, also some resources that you can access from some of the participating organizations in this webcast. So please take a look at that and download it if you like by hitting the file download pod in the bottom of your screen. You can view the audience or the participants, the panel members here, full screen by clicking the four arrows at the top right of the screen. As always, at the end of our webcast, we have a brief evaluation. We much appreciate that you incorporate some of your feedback that we can use for future programs. And finally, you can share this program on demand with any of your colleagues in your organization. It's available about 48 hours after the webcast. And then finally, and then we go to the content, some of you are joining us today because you can earn CPE credits. If you do so, then type your full name and email address in the space as it will be provided during the webcast. Click OK for free pop-ups that occur during the program. Stay online for the entire webcast. And of course, the credit is only available for participation in the live webcast only. And with that, we are going to go right into our first section, productivity and what is happening with productivity. And as always, we'd like to hear from you. So indeed, our first activity here is a poll question that is going to appear on the screen right now. And the poll question is a question to you, whether I am seeing accelerating recovery of productivity in my industry or in my country, whatever your perspective is. And I believe that productivity recovery is going to be sustained over the next few years. And you can answer this in different ways. You can say, yes, I definitely see stronger productivity growth recently, and I think it will stay. You can say, yes, I see some recovery, but I don't think it will last. You can say, I don't see much productivity growth now, but I think it will come sooner rather than later. Or you can say, no, I don't think we can expect productivity to improve anytime soon. Or maybe you just don't know. That also happens in this complex topic. So please take a little time to answer these questions, and then I'll ask each of our participants to very briefly respond to this. So we'll leave it open for about 10 more seconds, not 30. And now it's about 5, 4, 3, 2, 1, and 0, and we're closing it right now. So the outcome is that just over half of you are actually saying yes, there's some recovery, but I don't think it will last. And then there's about 1/3 of you, just over 1/4, says, well, it's not much better right now, but I think we will reaction to those results. I think we don't have Jana on right now.
Soon. So that is what I was expecting. So I'm actually surprised to see that people are more pessimistic, that over half are thinking that we will not see this lasting. I was hoping we would see something more optimistic.
Okay, well, let's see if we can make people more optimistic during the webcast. Derek, what's your first response?
I would say, yes, we do probably see a bit of recovery in a couple of countries. I think there was news in the United Kingdom recently that they are seeing some recovery in productivity. I think the fact whether it will last or not, we just don't know yet. It's hard to project productivity and look forward. I do hope it will last and that we will see some uptick going forward.
Stian, your first response to those poll results?
I think in the UK, as Doug said, we have recently seen some positive news on productivity. I think obviously we have to brave whatever comes in the global economy in the coming years, which could bring bad news. And obviously all of this will be dependent on UK government policy, how we deal with Brexit, take advantage of the opportunities there, and how our industry responds to that.
Michael, more reason for optimism in Germany on the productivity story?
And in Germany, we are very optimistic looking back on the last years, which were very strong growth. But on productivity, there are some first signals. So I think the signals not so strong enough to change the general mind. And we should be clear that we are looking back to the last 1.5 decades or 2 decades. It was an ongoing slowdown of productivity. So we need some more strong signals to go in. So I'm personally in the smaller group saying that just no, but we will see the stronger productivity growth later.
Okay, and Klaas, we're a little bit more optimistic, right? We think that there might actually be something happening here.
Yes, I guess we'll talk about it later a little bit more as well. But for me, the results are sort of what I expected. Also, there was recently a survey among some of the larger Belgian corporates, and about half of them were saying that they were seeing increasingly productivity gains from their digital transformation. So seems like it's
okay. So it's a very subtle and balanced story. Exactly. So before we go into the results, we first need to talk a little bit about what productivity is, because as I mentioned earlier, it's not something that's on a business leader's radar screen every day. So Jana, with the McKinsey Global Institute, having done a lot of work from a corporate perspective, how should we think about corporate productivity from a corporate perspective?
I think productivity is a very clear concept for most businesses. You are thinking about how much output you get for a given input. And most companies intuitively know that the more you get for what you put in, the better you'll do, better your right financial results. The one thing to keep in mind about productivity is that we sometimes focus more on the efficiency. So we think of the productivity story of only being half. It's a ratio of output to input. So clearly we can improve productivity by reducing the inputs needed for specific output. That's the efficiency case, that's the cost cutting, that's the labor efficiencies. However, the other half comes from the fact that you can increase the output for the inputs you put in. And that actually, when you look across the economy, has generated over half of the productivity growth over the last 50 decades or so. The fact that we now not just need fewer labor hours for each car produced, but the value of the car, the performance, the features have grown as much as the efficiency. So I think we need to keep both of those sides in mind.
Yeah, so I think in a way you're saying it's either cost cutting and cost efficiency, or it is growing scale and growing market share. And you're saying that at least that second part is at least as important for productivity growth as the first.
Exactly.
Right. So Klaas, let's go a little bit into the numbers now. We put out recent numbers up to 2018. Obviously, that's still a little bit of a projection.
Yeah.
What is this improvement that we're looking at? How big is it?
So I think, first of all, it's important to have clear what we're talking about. So when we talk about the slowdown in productivity, we don't mean that we're getting less productive every year. We're still increasing our productivity, but really what we mean is that over the last couple of decades, across advanced economies, we have seen a slowdown in the incremental rate of productivity growth. So when you look at, for example, around the 70s, we were seeing around 4 to 5% annual increase in productivity. And basically, you'd say every decade, it was 1 percentage point lower, up to the point that that in the last couple of years there was almost no productivity growth at all. This was particularly dramatic in the United States, where in 2016 productivity growth almost grinded to a halt. Mm-hmm. So this is really the big question that we're talking about, especially with all the digitization going on. Now, when we came out with the numbers last year, when we ran all the data, we have a very extensive data set. We try to match comparable data across all the countries in the world. When we ran the numbers last year, we thought we were seeing some kind of a turnaround, some improvements. It was still a bit weak. It was still a bit tentative signals. Right. When we redid it last month, we also ran our projections for this year, our forecasts. We can say that there's definitely this pickup, or there's definitely a pickup that we see in the numbers, and you can see it on the slide as well, that where you have 2016, 17, and 18. So that's really the short term, but you can really see that that the productivity growth has really picked up across advanced economies. And this is stronger, I think, this effect is stronger in Europe, especially, where we're almost back to the pre-crisis rates.
So why is this not just cyclical, you think?
I mean, for now, I'm just saying what we observe. Right. I think whether it's cyclical or structural is still something that is not yet clear, I think, from the numbers. Mm-hmm. I think what is clear from the numbers is that there's a bottoming out. So the slowdown, I think now we can say has stopped, and now I mean it's time for the way up. One of the things that you can look at just to gauge whether it's structural is, for example, labor productivity has a lot of stuff in it as well. I mean, also capital is measured in it. The human capital. I mean, if you strip out those effects, you have a much more refined measure of productivity, and for that, obviously, you need much more data. But also in that measure, you see some. We don't have the latest numbers yet, but also in that measure.
Yeah, and I think that's important, right? If we see the overall productivity of not just labor, but also capital and other things improving, it might actually be that there's something more structural in there.
Exactly.
As far as it goes beyond capacity utilization. And I think another key question that we obviously need to look at is how much is this spread across industries? We don't have time for that, but the more it's spread across industries, the more likely that this is going to be a little bit more structural in going forward.
Exactly.
Now, Dirk, I don't know if we have Dirk back in the meantime. We lost him just a minute ago. Hey, Dirk, great. Good to have you back. Because I want to go back to this issue of the productivity slowdown. Of course, we can't get overexcited about the recent recovery, but we do get a much better understanding of what the reasons for the slowdown are. There's several causes of that. So which ones are the most important in your view, and which ones matter most for us to tackle them in terms of trying to ride the current wave of improvement?
There is a lot of discussion on this, of course, and I don't think we know exactly what the slowdown comes from. I think if we really go back to the whole slowdown since the post-war period, well, partly we've run out of steam a little bit in sort of some of the catch-up growth, sort of where countries were learning from each other and firms were running from each other. So in that sense, some of the slowdown has been natural. I think what's more important is what we've seen in the past decades, when first I think we had a slowdown in sort of what's called multi-factor productivity growth, this whole effect, which is partly about technological change. And then since the crisis, we've also had a slowdown in investment, which meant that we've had less growth coming from capital deepening. Where exactly the slowdown comes from, I think we're still not entirely sure about. There are a lot of theories around it. I think one factor is probably that we had a lot of growth coming from digital technologies already in the 90s and early 2000s, particularly in the United States, but in a couple of European countries as well. I think a lot of people say, well, that's probably run out of steam a little bit. Now we have a lot of digital technologies coming in the pipeline at the moment. They're probably not quite working through into productivity growth yet either. So there are many things going on. I think one thing which we're trying to add to the debate from the OECD side is go a little bit beyond the aggregate story. So we did some work on looking at what we've called global frontier firms, basically looking at the firm level. And there we found that the top firms in different industries in the world have really still had pretty strong productivity growth, even going into the past decade. But a lot of the rest of the economy has fallen behind. So partly productivity growth is still going on. It's just not as broadly based as it needs to be to have a big impact on aggregate productivity. So I think that's part of the story. And we need to understand a little bit better why some firms are still doing so well and others are trailing behind.
So some people, Dirk, are saying that actually the financial crisis of the late 2000s, even though the productivity slowdown started earlier than that, but the financial crisis made this all significantly worse. Would you buy into that?
I think there have been impacts, and it's always hard to disentangle the cyclical impacts and the long-term impacts. I think one thing I mentioned already is that I think since the crisis we haven't had the same level of investment in many OECD economies, which is has really reduced labor productivity growth. I think the other thing which we are finding is that we've seen in many countries also a large number of firms having what we sometimes call zombie firms that are really have very, very poor productivity growth. They've accumulated in quite a few countries, and the crisis may have something to do with that. It may be because of partly soft monetary policy, which probably enabled some of these firms to survive. They might have otherwise exited the market. So yes, I think there are impacts of the crisis as well on productivity growth as we see it at the moment.
Yeah. And you make a very good point. You really need to look under the hood of the macro numbers to really understand what's going on, whether it's by sector or by firms, as you're describing. But let's stay with the country for a second. I want to hear from Michael, just from a Germany perspective. What is the story about the slow productivity growth that you actually alluded to earlier in Germany? You know, a country has been actually doing pretty well coming out of the crisis compared to other countries, but still productivity growth is slow.
Yeah, we have some different arguments, but some are the same. In the crisis, we react in a very different way to some other countries. You know, we have this special short-term working scheme, 100% unemployed, but you could receive your money, and we did something like labor holding in our companies in the year 2009, 2010 due to these different specific incentives from economic policy. So this will pronounce the reduction of productivity in this period. And now we are working on this since 2013. And the productivity growth is more pronounced, and it's coming back, and you can see it in the macro figures. But another aspect is interesting to see in Germany is what we call the shortage of skilled labor. So still we have the argument of labor hoarding in the companies. It's reasonable to a certain degree, but not to 100%. But if you ask on the firm level, what I do several times, if I have a chance to get some information, anecdotal evidence from the firm level, what I have heard is following. They're saying the production scheme, which we can reorganize due to the digital possibilities, the digital transformation, then we will have a gain of productivity of more than 30%. But at the same time, on the company level, we can bring all the free labor force back to another productivity usefulness because we have a growing market, we have a growing business model. So overall, the pronounced effect and impact of digitization on the firm level, the production scheme level, is not reflected on the macro level, on the macro data, despite of the fact that since 2013 we had some positive developments.
Okay, right. And indeed, the whole issue of digital transformation we'll come back to in a second. But before that, Stian, from a UK perspective, productivity growth has been really slow in the UK, and we know that to some extent it was offset by a good recovery in employment. It's been a bit of an employment miracle actually in the UK. But now the question is, we still don't quite understand why productivity growth in the UK has been especially slow.
Yes, you're right. Productivity growth in the UK has been extremely disappointing. The upside of our flexible labour market and probably swift intervention by the Bank of England after the financial crisis did mean that we've had remarkably strong employment, with the strongest employment figures ever. But as you say, the flip side of that has been very disappointing productivity growth, despite the very recent small uptick. I think there are a couple of possible drivers for that. One thing that is often remarked on is that the UK, even relative to some other rich countries, has a particularly large long tail of low productivity firms, of the kind of laggard firms that the OECD has talked a lot about. And that seems to be part of the problem. But something very curious about the whole leaders laggards issue in the UK, which seems to be potentially different to the situation in the US and perhaps other countries, is that according to some recent analysis from the Bank of England, it seems possible that our productivity downturn since 2009 has been concentrated not in the laggard firms, but in the leader firms. And some of that may be historically contingent. Some of that may be because some of our high productivity firms have been in the oil and gas sector, and our oil and gas productivity is dropping, production is dropping. Some of it may be financial services driven. Obviously, the increase in regulation in financial services since the crisis may have particularly affected the UK, given the concentration of high productivity financial services in the City of London. But something unusual is going on in that there's been a concentration in some of those leader firms rather than just in the laggards.
That's extremely interesting. Maybe we can come back to that a little later, that you are identifying that actually there's an issue in some countries, including the UK, in the leading firms. So that's a really interesting observation. Before we move on to digital... Yeah, please, go ahead.
An interesting case for me is if you compare Germany and UK, you see the similar performance in labor markets since the big crisis. We have more or less a similar labor participation ratio, a similar unemployment ratio. But if I'm asking for the reflex on the fiscal side, in Germany, the fiscal surplus is now for 4 years, or will go on for the future, and UK is still struggling with a high deficit in the budget. So if you are saying that the main basis for the income side, the revenue side of the public budget is high labor participation, the question is what's going on with the quality of labor. And my interpretation is that there's a change, that has something to do with productivity. Before the crisis, high paid jobs, and they were substituted with low paid jobs after the crisis. And is this a hypothesis convincing for you?
Yes, I think there's. Yeah. I think there is certainly. Oh, sorry. I think if we look at what's happened in the UK in terms of the wage performance, as you say, although there's been a little bit of moderate good news recently, wage performance has been disappointing since the crisis too. So that seems like a plausible explanation.
Good. So let's move on to the issue of digital transformation. And Jana, you may want to take it sort of almost naturally forward from this slowdown towards the question of how we're going to solve this productivity puzzle. And in the recent study by the McKinsey Global Institute that we mentioned earlier, there are actually two main drivers that you were identifying. First of all, there's the role of demand that perhaps has been somewhat understated in some of the earlier work around the causes of the productivity slowdown. And secondly, the role of digital transformation. So, but you also call it a promise. And that really leads then to the question, it doesn't seem that the promise is yet fully fulfilled. So what is really holding up this productivity recovery right now, and how do you link that to these issues of demand and digital transformation?
Yeah, so when we looked across the industries, it was pretty clear that the negative impact that the downturn had on productivity by reducing capacity utilization, shifting people to lower value goods, etc., all of that has largely played its course. There are some longer term demand issues that we can come back to later on, but the promise really that we refer to is the promise of digital. Just like in the late 1990s with the first wave of ICT revolution, it took a long time for companies to figure out how to make the most of the client-server ICT technology. Right now, what we are seeing is the digital technologies transforming the opportunities of productivity gains in all sectors that we have studied. But the challenge is that today's change is much more fundamental in most cases than what we saw in the past. So it's going to take a longer time to get there. So let me give you an example of retail. In the previous wave of technology innovation, we were really looking to improve the supply chain so that retailers would be able to get the right goods to the right place at the right time. So it was a business model that they were optimizing with new ICT tools. What's happening now is that the change is not just making the operations better and faster and more efficient. It is the fact that we are trying to figure out how to combine brick and mortar with online retailing and finding somewhat of a Goldilocks mix between the two. There are very few pure play online players now that Amazon has acquired Whole Foods, and most brick and mortars are looking for the right way to balance. And that's going to shift much more than just making the existing operations better. You need to find out what's the mix between different channels. How is your distribution network changing? The locations are not going to be the same if you are distributing to homes versus to the stores as you used in the past. So the reason why we talk about the promise is that in the past, technologies that have been transformative have taken between 8 to 28 years to come at scale and really become broadly adopted. We should expect exactly the same thing to happen this time. And frankly, wherever you start counting, we are so much closer to the 8 than we are on the 28. So over the next decade and two, we should really expect to see harnessing of the benefits of all of the changes and all of the investment and all the managerial time and money going into digital.
Right. So this is a very good transition to Stian's work and the work you did together with Jonathan Haskell on this so-called concept of intangible capital. I mean, Jana talked about investment and everything we do, but a lot of that is actually not measured as investment. It's kind of business spending on a lot of things to make our organizations ready for this new productivity wave of digital transformation. So how does that intangible capital story fit into this? Are we missing perhaps something in the debate here that actually companies are doing a lot of things that we're not properly measuring, and therefore we think there is a productivity slowdown, whereas in a way it may actually not be happening right now. We may actually be seeing more of a recovery than we actually measure at the moment.
So I think the growth of intangible investment does help us understand possibly why productivity has slowed down. Unfortunately, it's not as good a news story as you might have implied. So the book that Jonathan Haskell and I wrote, Capitalism Without Capital, tells a story of how over the last really 30 or 40 years, there's been a dramatic change in the kind of investments that businesses make across rich countries and across the economy. Once upon a time, we invested in physical things like machines and factories and vehicles vehicles. Now firms, for the most part, the majority of investment is things that you cannot touch and feel, intangibles. And those are things, the kind of things that Jana was talking about, the kind of business processes that you need to implement new technologies. It includes software, it includes R&D, it includes investment in brands and marketing and so forth. So those now represent the majority of investment. And the first thing to say about them is that these things are typically very poorly measured in national accounts, and they're even more badly measured, even worse measured in company accounts. And that, to a certain extent, accounts for a little bit of the productivity slowdown. If you measure these things correctly, you get a little bit more of an increase in productivity. But as I said, unfortunately, that doesn't make our problem go away entirely. It's a small part of the productivity gap.
But there is an interesting concept that you are describing around intangible capital investment. Just to put some meat on the bones, what is special about that intangible capital? You're using this concept of the 4 S's. There's something that's different in all these business spending that companies are doing compared to the investment in hardware and software.
That's right. We described that intangible capital is different from tangible capital because it has these 4 S characteristics. The S's are that intangible capital is scalable. If you invest in something like the Uber algorithm, you can scale it across a very large business. The second thing is that they tend to be sunken. If you have lots of intangible assets and your business goes bust, they're typically little use to creditors, which means it's harder to raise bank finance against intangible assets. The third S is spillovers. A firm may make an intangible asset, but maybe its competitors will also benefit, in the way that when Apple designed the radically different iPhone form factor in 2007, they made a design investment. Within 18 months, all smartphones had the same form factor. The investment spilled over. And the final S is synergies, that intangibles tend to be especially good when you bring them together with other intangibles. Technologies and software and business processes, as Jana said, they're really productive and profitable when you combine them. And this does help us understand another aspect of the productivity slowdown. Because as we were saying, a lot of the productivity slowdown, not just in the UK, in the US, in other rich countries, has been concentrated in TFP, not in physical capital, but in the kind of spillovers element of the economy. And one of the other things that we've seen is that since the global financial crisis, investment in intangibles is still growing, but the growth rate is considerably slower than it was before 2009. And one of the things, because intangible capital has these spillovers, you would expect to see, as that rate of growth slows down, that TFP would slow down too. So this kind of comes back, I think, to Jana's story, which is that firms need to invest more in these complementary investments that are needed to make technologies real, the business processes, the training, the branding, the organizational development. And that for various reasons, it seems that has slowed down since the financial crisis, causing this fall in TFP that we've seen.
Right. So Derek, I want to go back to the work that you're doing at the OECD, because I think some of the things that Steen is talking about, scalability, spillover, synergy, is some of the things that you talked already a little earlier about the firm level work that you guys are doing at the OECD. That those kind of assets seems to be coming back in your analysis of the productivity slowdown too.
Yeah, no, absolutely. I mean, first to say that I think a lot of the work we do really confirms also, I think, what Jana was saying. I think we're still seeing the technology feeding through. We collect a lot of indicators at the OECD where we look at the uptake of information technology, and we still see that it's still moving ahead, but there's still a way to go before it's really having an impact. And then secondly, I think related to what Steen was saying, I think sometimes we focus a little bit too much on the technology and not enough on all the other things which need to happen in firms in terms of these intangible investments, but also process changes, organizational changes, and so on, which are often a lot slower and a lot harder to do than buying or investing in the technology itself. I think the other thing, and that's what you were alluding to, what we are finding in a lot of the work which we do with firm-level data is as well that the impacts of technology partly come from firms that are figuring this out, scaling, growing, gaining market share, and firms that are not really figuring it out, losing market share over time. So you get these changes in the composition of an industry, of the economy itself, where some of those more dynamic firms are growing, and that really leads to the impact on productivity. I think there are differences in countries on that. some of the work which we've done on scaling of firms, for instance, shows that firms grow a lot more and a lot more quickly in the US if they succeed the first few years than they would do in Europe. And that is related, I think, to some of the impacts which we've seen of digitalization on productivity, in the sense that if you have that scaling of dynamic firms, of digital firms, then you will see these impacts a lot more quickly than if you don't. So I think that's an element which we need to keep in mind. It's not only about technology, but it needs to feed through and sort of the creative destruction process, as economists sometimes call it, where you have entry, exit, and growth of firms. That's a big part of it too.
Right, Klaus, you wanted to respond to this a bit.
Well, I think I hear a little bit of a tension between what Jana and what Steen were saying. So if I understand it correctly from Jana, we get the picture that we're currently much more in this installation phase, right? So it takes a while before we see the effects of this transformation coming into the productivity data. And it was also a little bit compared with the uptick in the 90s, which I think is not a very strong comparison, because that was, if we have to wait for that productivity growth, I'm not sure if it's that's worth it, because that petered out pretty quickly, and most of the profitability evaporated with the 2001 recession. But still, if you compare it to the larger transformations in the earlier years, so it seems like we're in for some increase there. But then what Steen is saying is that, look, this time it seems to be different. We have this intangible capital, which seems to be creating these a very large winner firms, winner takes all firms basically, and that's what we have seen in the OECD statistics. So there seems to be a little bit of a tension between those two. Is it this time different, or is it this time the same as the previous? I guess that's the tension.
Yeah, are you saying that this time is the same as in the past? I'm not sure, but how different is it?
Well, I was using the contrast between the late 1990s exactly as an example, that actually was a relatively contained optimization of the business processes as we knew them. This time, the change is much more dramatic. We also saw that, for example, the decline in investment came from the physical investments, from housing, especially in some countries. It didn't come from the intangibles, which continued. There was a small blip in 2009, but they got back up very, very quickly, so very consistently with our co-panelist. However, what we are seeing, the change in digital, is quite dramatic, and it is not just a change for businesses. I think most of the folks who are listening to this probably see in their own business as there is somewhat of an excitement about the potential for digital, but there is also the fear of the digital attackers, of the business model changes, of actually the industry structure and dynamic changes that are coming. We see that, for example, with new platform players like Amazon, eBay, many others who allow lots of small players to come in and compete. They dramatically expand the long tail of small players in an industry. At the same time, they create some very large economies of scale in some of these close to zero marginal cost businesses. So we are going to have a very different business environment. And frankly, as economists, we will have to figure out how do we analyze the industries, because we will have pretty significant shift in the supply side, a supply curve, if you want, in our models. So I think the nature of the change, I am by no means saying that that's what we saw in the late 1990s. I think this will be very different. It will be interesting to watch.
Yeah, and indeed, this time is different. It's absolutely true for the labor market, which is really the third topic I want to go to. And before I ask Michael to introduce this topic to us, I want to actually start with a question on this, a poll question, because this is a topic that's on everybody's mind. Is sort of, how will productivity growth actually impact on the job creation and on the job market? So here are a couple of options that you can look at. The question is, how will productivity growth impact on job creation? Your answer could be, in this digital transformation age, more productivity growth will be a job killer, and it will basically impact almost across all occupations. The other possibility is productivity growth will make talent shortages an even more a more critical bottleneck in the labor market. Your third answer is productivity growth will cause significant labor market disruptions, as some people lose their job while other occupations are hard to fill. And the fourth is productivity growth is the labor market's best friend because it will grow the economy and it will therefore raise the demand for better jobs. So take your time. These answers are always a little bit more complex than these are not simple questions when you talk about productivity. Just pick the one you're kind of most comfortable with, which you think is most important when talking about the impact of productivity growth on job creation. And then I'll ask each of the panel members to react very quickly, and then I will go on with Michael to highlight this a little bit from Germany's perspective. So we leave the line open for another 5 seconds or so. 5, 4, 3, 2, 1, and now we'll stop. So basically, it's quite interesting. Just over half of you say productivity growth will cause significant labor market disruptions, as some people will lose their job while other occupations are hard to fill. And then just half of them, just a little less than half, will say, well, in the end, it's the best friend because it will grow more jobs because the economy is going to grow. There are not many pessimists among you on this webcast today that basically say this is going to be terrible and completely change more bottlenecks and kill jobs across the board. Very quickly, Dirk, first response. Is that what you hear among policymakers, that in the end this is all going to be good? Or are there major concerns?
We just put out a study at the OECD a few weeks ago on the impacts of digitalization on productivity, on jobs actually, and there we basically say that we think the real issue is polarization, which I think is the third question. So basically you have some people who will be losing their jobs, and particularly on the low end, and at the same time we also will have shortages because of there will be a lot of demand for the high end. We don't see a world without work right now. We think there will be lots of job growth as well, and that's where the productivity growth comes into it as well.
Right.
We do expect this polarization in the labor market.
Jana, your view too? I think so. I've seen an earlier McKinsey study on this, fairly optimistic.
Yes, I think the number 3, disruption, is certainly with us. That's the nature of the beast. However, historically, the 44% of you, I think many of you are economists, that productivity has been the engine of income growth that creates demand for new kinds of jobs and new kinds of opportunities. So just about what I would agree with the poll results.
Yeah. Stian, any perspective from your side on these poll results?
I think it's definitely true that productivity is going to cause labor market disruption. I think it's going to be very interesting how it pans out, though. I think typically the response is, well, people will need STEM skills, digital skills, coding skills to deal with this economy. I think that may be true to some extent, but I think also human skills, creativity, the ability to work in teams and to bring together some of these intangible assets may be important as well. So I think it will change what workers need, the skills workers need, but it may be non-obvious the skills that actually are in demand in the future economy.
Right. Klaas.
Yeah, I think it's an interesting nexus also that we have here, because on the one hand, when you ask people, do you want a raise? I mean, of course, people want to earn more money, and I think productivity growth is the way to go there. On the other hand, people fear that their jobs will go away. So there's a funny
tension here.
Tension here. Yeah.
So Michael, I think it's interesting to actually start this discussion from the perspective of Germany, because Germany, of course, has been doing relatively well on the labor market front in the last couple of years compared to other countries. And its productivity growth, although it's not as great as you mentioned earlier, it's certainly not terrible compared to what we're seeing in some other countries. So I sometimes wonder if Germany is not the ultimate proof that productivity growth and employment growth can go together. So what's your perspective here?
And my starting point is saying we have to look on the structure of the economy. And it's a point also looking back to what is the impact of digitization. If you want to understand all these changes, you have to look at the structural change in Germany. We know we have a high share of manufacturing. 23% of GDP is manufacturing. And as a joint production sector, we define this manufacturing plus the service sector activities. 1/3 of GDP is higher than all the other big economies around the world. From this side, we are very successful in creating new jobs inside manufacturing, but outside manufacturing as a networking effect. And it's really interesting to see that the labor participation ratio in Germany was in 2000 69%, and now it's 80%. and the quality of labor is more or less the same. In average, the labor volume is more or less the same, the working hours. So we see it's really an interesting case as an answer to the outcome of our questionnaire. Just I think those answers not really a contradiction. We always have this structural change. At the end of the day, on the macro level, if you have an open market, you have an open economy, open borders, then you will have a growth effect, and this growth effect will create, in the end, more jobs than before. And that will also be true this time. So this time, from my perspective, will not be different in this working of the structural change and the impact of digitization on labor market. And what we see in Germany is that in the time since 2013, when the employment growth picked up, at the same time the real wages picked up. So what we saw in the crisis period, more stable or negative growth of real wages, changed totally. We have both in line. We have a real wage growth and we have a growth of employment. And that's really an interesting case. It's the German economy is doing very well due to this business model. If you're looking at the studies which are on the table for Germany, what is the impact from the low-cost imports from China, for example, there are specific regions that have a burden from this import, but at the same time, they were also able to react in a more flexible way to create new jobs close to the spot of the form of the old enterprise or the old jobs we had. So it's really an interesting story.
Yeah.
If you're looking forward to 2018, 2019, all forecasts say this story will go on.
Right. Yeah, and I think again, and Steve, I want to also have you look a little bit at this from the UK perspective. This need to look at sectors, you know, in the case of the UK, manufacturing versus services, but also regions seem to be an important part of the narrative in the UK too, right?
That's certainly true. And the UK has a perhaps unusual, unfortunate economic position from the point of view of the economic geography, where our economic growth happens, to the extent that we have a relatively high productivity economy, particularly in the southeast of the country and some very successful agglomerations, and much lower productivity in many other parts of the country. Yeah. And certainly if you look at the economic performance of a lot of the UK's largest cities outside of the southeast, they are less productive than you'd expect a big city to be in other rich countries. The benefits of clustering from those cities are lower than we would normally expect. And I think there's some interesting questions there. What we can do about our planning laws to make it easier to build, what we can do about infrastructure investment, and what we can do about public investment in research and development there.
Yeah. Jan, I just want to go quickly back before we move to the policy environment. I just want to go back to this earlier McKinsey Global Institute study that really talked about sort of, you know, the trade-off between automation and employment. You know, 60% of jobs was one of the findings will have at least have 30% of the tasks in those jobs that can be automated, but that in the end, only about 15% of current work activities will be replaced by automation. So it's interesting that there seems to be a lot more opportunity than what is actually going to be realized. So how do we sort of align that with optimism around productivity growth?
Yes, well, technology has always been labor saving. That's its power. And the fact that we all got computers, I think, makes us all individually realize that we can do a lot more, a lot faster than we could in the past. And many of the digital tools will be very similar. So if you recall the way we talked about productivity, we will be much more efficient in getting the same output for the given input with the new digital tools. And the time and the resources can now be allocated into doing something better, having fewer failures, in a way improving the output for each hour we spent working. So I think that is our optimism. It is really, as long as you don't focus on just on the efficiency gains, on the cost cutting, you focus on the potential. And we are seeing that already in many of the, let's say, retail food operations where automated cashiers, customers ordering their own orders, a lot of that labor has shifted into keeping the restaurants cleaner, increasing quality of service, etc. It doesn't necessarily mean that you need to reduce the workforce. However, to finish on a cautionary note, there are some big changes in the overall growth rate of the economy, and typically the jobs lost will be replaced by new jobs created. Unless we see continuing sustained productivity growth that translates into aggregate demand, that money goes into the pockets of those people who spend, we may see some of that virtuous cycle slowing down. And two trends worry us there. One of them is the sustained longer-term decline in wage share of income. We know that wages tend to have a much higher propensity to consume than profits. So if we are fueling money from one pocket that spends to those who spend, that might be a factor, as will income inequality. But overall, we don't see that the fact that automation has such potential to increase productivity will need to lead to job losses. We just need to keep the economy humming.
So, Jana, I want to stay with you for 1 second because there's a question coming in that I think you are best positioned to tackle. And the question is, how do we explain the outright productivity decline seen in many three-digit manufacturing sectors in the US over the past 10 years? Surely we know how to measure manufacturing productivity. So just focusing a little bit more on this manufacturing story, how can that be?
Absolutely. Well, that is the demand story and the downturn impact that we estimate actually led to a 1 full percentage point decline in productivity growth across Western Europe and US. And the reason is that when you, for example, in the US, the output of vehicles produced declined by 50% between 2008 and 2010. So there's a dramatic drop in capacity utilization. You are not able to reduce your employees and your investments at the proportional rate. Similarly, we saw a lot of the economies of scale, particularly in the financial industry, decline. For example, loan volumes, mortgage volumes, etc., were declining, as were transactions. And in retail, people were shifting to lower value per unit goods. So think about, for example, bottles of wine. In a boom time, people might spend $20 on a bottle, and on a downturn, they shifted to $6 bottles. Yet the labor that goes and the resources that go into transporting that bottle, stocking it on the shelves, and scanning it on the outside, on the cashier are exactly the same. So these are the factors that can, even in advanced economies, can dramatically impact productivity in the short run. And we saw that happen.
May I add to this question just two short points?
Yes, please. Just 30 seconds, please. Yes.
One point is very important. The manufacturing sector in the United States is not embedded in an ecosystem. If you're looking for the firms, the companies, they are standalone firms. That's an outcome of the MIT study Making America 2013. Another point, and it's totally different in Germany, this is an ecosystem economy, a network system economy. So you have a broader base for reacting, for more flexible to create productivity. And the second point is the vocational training system we do have in Germany. That's a very close fit to the manufacturing sector. It's a lack on this in the United States after all this talk about vocational training.
Jana, 30 seconds response.
I think that's absolutely right. And I think Germany actually didn't end up having as hard of a demand shock either. Germany tends to export a much larger share of their vehicles, and particularly the booming demand from Germany helped keep the output per capacity much higher level there than we saw in the US. So fully agree.
Yeah. Okay, Dirk, we only have a few minutes left to talk about policy, but I do want to have you talk a little bit about what are the most important policy measures that OECD is now talking about to really begin to accelerate productivity. Can you tell us in sort of 2-3 minutes? Give us the headlines.
Sure, I'll try. I mean, I don't think we have a one-size-fits-all approach to productivity growth. There are very big differences across countries in terms of what is driving productivity growth. I think there are a couple of things which we typically look at. One are some of the things that are driving knowledge creation in terms of what do we need to do to keep the economy going in terms of front runners, in terms of technology, of innovation. What do we need to do in terms of investment in research and capabilities also like education and skills. Then we're doing a lot of work on looking, well, what do we need to do to diffuse some of these innovations and practices across the economy. And then we're looking at issues related to what I mentioned earlier on resource allocation. Now, there are lots of policies behind that in terms of how do financial markets work, how do we allocate capital, how do our labor markets work, how do we invest in education and research and in infrastructure in different countries. A lot of factors behind it. I think what's more interesting to say is try to say, well, there are different groups of countries. So when we are, for instance, looking at emerging economies, we typically focus on issues like improving rules and regulations, starting to invest in certain capabilities like education, like infrastructure, and say, well, these are some of the things you need to do to improve productivity. When you're dealing more with front-runners, countries that are very highly innovative and sometimes very productive, I think the story is often more subtle. It's about specific regulations, it's about specific policies, it's about skills, it's about sort of really working on specific issues. And that's what we do in working with our member countries to help them both on the labor market side and on the productivity side. And I think what Jana mentioned a second ago, the focus, I think, is increasingly also, well, how is that productivity growth and distributed? Who's benefiting? What is the impact on wages of different group, and how can we sort of make sure that we have productivity growth which is pretty broadly based? Just to give you one example of the types of things we had review, which the OECD recently did of Ireland, which is an economy which has very strong multinational firms, but pretty weak productivity growth in the domestic economy. And then we were looking at recommendations on skills, on infrastructure, but even on housing policies in terms of trying to encourage more mobility in the economy and helping people move to areas where their skills could be best put at use. So I think there are, it's very country specific, I think, when you go into the detail, but there are sometimes things which can really help boost productivity in specific countries if you're doing that. And that's a little bit what we're doing also in improving the evidence base and working with countries that with very detailed data to really get better insights what's happening.
I really want to use the last few minutes by giving each of you a chance to respond to this and other comments made. And I'm going to do that first by asking the final poll question, and then each of you can take about 30 seconds to respond to that. So that poll question should be coming up right now. And the poll question is, what are your expectations? So we're going to look forward here. What are your expectations with regard to productivity growth in OECD countries? Let's focus for the moment just on US and Europe. And the sort of three possible answers or no, of course. So the first is, we'll need more productivity growth to sustain, and technology and innovation will make that ultimately happen. The second would be, we'll need more productivity growth to sustain growth, but we won't get it easily because of regulation, lack of education, inequality, failing investment policy. So this is a little bit more for the pessimists among you who think, yeah, we may not quite get there. Or there may be even some among you who say, well, we should not focus that much on productivity growth because ultimately this is about jobs. And that will be much more important for long-term living standards than productivity. So think a little bit, and then of course you can always say don't know. So think a little bit about this, where you put your emphasis on this story, and then I will ask each of our respondents to use their last 30 seconds to respond to this or respond to anything else that they want to bring to the table right now. And we take 5 more seconds. 5, 4, 3, 2, 1. Okay, we're closing it now, and there's a very, very clear majority, about 3/4, actually exactly 3/4 by this point, and there are more than 4 people responding here. Oh, well, somebody last minute actually changed. They're still changing. We need to close it, guys. Very good. 2/3 are now saying we'll need more productivity growth to sustain growth, but we won't get it easily because of regulation, lack of education, inequality, and failing investment policies. 1/3 of you, just over, say we will need it, and we will get it because technology and innovation are ultimately going to do the job. Michael, let me start with you this time and say quick response to this or anything else you want to break on in your 30 remaining seconds.
Yeah, I think the answer is convincing for me because there's some skepticism about policy action. There is some need for policy action. We want to have higher productivity growth. We have heard a lot from Dirk. I will add we need tax relief on research and development expenditure. We need open markets. We need a perspective on free market in this time of protectionism. It's very important. So if the companies can interact worldwide, they have a standard, they can look for better solutions, and they will have the room for gaining higher productivity increases. So I think it's very important that we focus on the need for policy action as described, for example, from OECD or the German Council of Economic Advisors. I'm totally aligned with that, but focus on research and development.
Yeah. Stian, are you also with the majority of this vote, or do you think that ultimately technology innovation will just going to do it?
I am with the majority on this question. I think there are two particularly important policy measures. Firstly, the need for public investment in things like R&D, because these are investments that have spillovers, and therefore the private sector will not provide the optimal amount. And the second is this regulation question. As Jana said, we're looking at a new economy with new ways of doing things. Our regulatory systems need to keep up with that to make sure we have the right set of rules for a new economy.
Klaas.
Yeah, I'm also slightly optimistic. I think it's out of the question whether we need it or not. I think that's definitely in our current environment with the aging societies, with the debt, public debt situation, and you name it, that it's necessary that we have productivity growth. I think a larger worry that I have is that, and some of the research in the US is showing that over the last couple of decades, there has been productivity growth that has not really translated into real wage growth for the majority of the population. And I think that's a larger issue. If you have productivity growth, but it only goes to a smaller segment of the distribution effects, are definitely important.
Jana, any final response?
I agree with the majority. I think it will be tougher this time than it was in the last 50 years when the demographic momentum was giving us 1.7% of GDP growth simply because we had more consumers every year. Now, I think regulation, which I was already mentioned, and the demand side, making sure we actually do get the engine humming will require not just company action, but also policy action in a different way that we have seen in the past. So it will be harder, but we can do it.
And Dirk, I'm sure you're with the majority here that policy measures is what's needed here.
I do think policy does definitely play a role, and we're a bit worried that we've seen a slowdown in the pace of structural reform in many of our member countries in the past few years, which probably means that some of that policy action isn't really feeding through. And I think we probably need it now more than ever because of this digital revolution, which really does it requires different policies than we've been having so far. So I think we might start seeing it in a couple of countries, perhaps, because some countries probably have this figured out a little bit better than others, and hopefully then it will feed through to others.
Great. Well, we're at the top of the hour. There's definitely 2 more hours to talk about, and we covered a lot of ground. And I'd really like to thank all our panel members, Jana Reemans, Dirk Pilat, Michael Hutter, Steen Westlake, and Klaas de Vries, for joining us today. In this slide, you see a few of the resources that some of the participating organizations today have on productivity. So feel free to download the deck and go to those URLs. And then finally, this is a program. We come back to you again the last Wednesday of next month. And that's just 2 days before the General Data Protection Regulation in Europe will be introduced. So that's going to be the topic. We're working again on a great panel, and we hope to see you again soon. Thank you for joining the Window On series. I'm Bart Farrer, Chief Economist at the Conference Board.